Let us commence this module by understanding the concept of money market. Financial market in an economy plays an important role for channelizing savings into investment. Savings can be converted into investment either directly or indirectly. When savings are directly converted into investments, they are called as real investments and they are not rooted through the financial markets. Purchase of capital asset for the use in business with own funds is an example of real investment, that is, savings converted into investments directly. In such a case, there is no need of financial markets. Financial investments are made through various financial instruments such as shares, bonds, fixed deposits, receipts, etc. These financial instruments are bought and sold in financial market. Hence, the role of financial market becomes very important in channelizing the savings into investments. If financial market is not effective, then savings cannot be channelized into savings, which in turn would be detrimental to country's economic prospectus. Financial market deals with financial instruments. These financial instruments, on the basis of their tenure, can be broadly divided into two categories, that is, long-term and short-term. Long-term financial instruments have a tenure of more than 1 year, whereas short-term financial instruments have a tenure of 1 year or less. The segment of financial instruments is capital market, whereas another segment of financial market that deals with the short-term financial instruments is money market. Therefore, money market is the market for the short-term financial instruments, that is, instruments having the maturities of 1 year or less than 1 year. As these financial instruments have short maturities, they are highly liquid in nature and nearly equivalent to money. For this reason, the market for these short-term financial instruments is also known as money market. After studying this module, you shall be able to know the concept of money market, know the various reforms in the Indian money market, understand about the structure of money market in India, understand the various instruments of money market in India. Let us now move on to discuss the major reforms in Indian money market. Before the financial liberalization that started during the mid-80s in India, the money market in India was highly unorganized and has narrow base. There was lack of integration among organized and unorganized sector. Even the unorganized sector was highly regulated. Due to regulations, money market grew in India, but there were inefficiencies in the market. There were regulations both as to volume and rate. Regulations as to volume and rate prevent the financial market to achieve allocative efficiency. Regulation as to volume impairs the financial market ability to allocate funds to its most profitable use. Up to early 90s, the money market in India had a narrow base and there were limited number of participants such as nationalized banks, life insurance corporations and the Unit Trust of India. Secondly, there were limited number of instruments in the market such as call or notice money market, participation certificate, interbank deposits or loans, commercial bills and 91-day treasury bills. The Reserve Bank of India, that is RBI, used to administer and regulate the interest rates. Banking facilities were insufficient with a restricted bill market. seasonal shortage and surplus of funds, limited foreign funds as compared to the developed money market like London money market, inefficient payment system and lack of transparency. The reserve requirement such as cash reserve ratio and statutory liquidity ratio were on the higher side. RBI has brought radical changes in the money market so as to make it more efficient and dynamic. Some of these changes are as follows. First, many new instruments for insurance, 182 days treasury bills, 364 days treasury bills, commercial paper, certificates of deposit were introduced to broaden the base of money market. Second, the regulations regarding interest rate was freed in stages from October 1988. A move from the regulated rates of interest or to market determined interest rate was also made. Third, the development of secondary market was attempted by setting up of new instruments which could increase the efficiency and liquidity of money market. Fourth, a system of primary dealers were introduced in the government securities market or the money market. Fifth, many new instruments such as repos, reverse repos, marginal standing facility, collateralized borrowing and lending obligations, etc. were gradually introduced in the money market. These measures, along with the developments in the government securities market, are the basic milestones of the money market reforms. Nevertheless, despite all these efforts, no effective measures were taken to integrate the unorganized part of the Indian money market with its organized part. Now, as we have understood the reforms in the money market, let us discuss the structure of money market in India. The structure of Indian money market is diagrammatically shown as follows. Government. Government enters into money market for meeting the difference between their spending and receipts. As the government spending surpasses their receipts, government issues treasury bonds and other securities to finance their deficit. Reserve Bank of India. Reserve Bank of India is one of the dominant participants of the money market in India. The effectiveness of monetary policies of the RBI depends upon the effectiveness of the money market. RBI not only provides funds to the government but also provides funds to the banks. RBI has many effective tools for influencing the money market. Treasury bonds, though represents the debt of government, is primarily routed through RBI. RBI initially auctions these bonds and finally discharges it at maturity. RBI also influences the liquidity in an economy by buying and selling of the treasury bonds through open market operations, thereby affecting the money supply of an economy. RBI is also a regulator authority for the banks. It determines the CRR and SLR. CRR is the minimum ratio at which banks has to maintain reserves on its total of demand and time liabilities in the form of deposits with RBI. SLR is the minimum ratio at which banks has to maintain reserves on its total of demand and time liabilities in the form of cash, gold and certain specific securities. CRR and SLRs are very effective tools for regulating liquidity and credit creation capacity of bank, which in turn affect the money supply. Primary dealers. Primary dealers are enlarged wings of the RBI to facilitate or support the government borrowings such as treasury bills. They were set up in 1996. The role of primary dealers is to strengthen the market of government securities in order to make it dynamic, liquid and broad-based. Primary dealers have improved the secondary market for the government securities, and they are effective medium in the open market operations of RBI. Primary dealers have an active role in the government securities market, both in the primary and the secondary market segments. Non-bank financial instruments. The following non-bank financial institutions are actively involved in the money market. First, mutual funds. Second, insurance funds. And third, the pension funds. Mutual funds. Mutual funds, besides deepening the capital market, have also broadened and deepened the money market in India. Money market mutual funds were introduced in India in April 1991, and due to this, the money market instruments, which were previously restricted to large and corporate houses, have come within the reach of individuals. These funds have been tremendous growth over the years. Insurance funds. Insurance funds, whether life or non-life, are also active participants in money market. Insurance funds are strictly regulated as to their investment norms, but they can borrow funds in case of shortage of funds from the money market, or also lend funds in case of surplus of money market. They are just like mutual funds are operating in every segment of the money market except call money market. Liabilities accrued to the insurance company, often on unpredictable basis. In such circumstances, insurance companies, for meeting their unexpected liabilities, approach the money market through repos, collateralized borrowings and lending operations, commercial papers, etc. Pension funds. Pension funds are also regulated on their investment norms. However, just like insurance companies, they are also free to approach money market during the shortage or surplus of funds. Pension funds can invest in money market instruments such as treasury bonds, certificates of deposits, commercial paper, collateralized borrowings and lending operations, etc. Companies. Companies here imply non-banking companies. Business largely depends upon commercial banks for their short-term borrowings. These short-term borrowings are in the form of cash, credit, bank overdraft or discounting of bills. Large companies having good credit worthiness can also meet their short-term requirement of funds by issue of commercial paper. Individuals. In case of need of funds for the short-term purpose, individuals have very limited options. They have to mainly depend upon the commercial banks. Commercial banks provide short-term credit in the form of cash credit, bank overdraft or discounting of bills. As far as investments of surplus funds for the short term is concerned, individuals, just like companies, have many options such as investments in the treasury bonds, purchase of the certificates of deposits and commercial papers, investment in the money market, mutual funds, etc. Money market in India has various instruments. Let us now understand them. Call or notice money. Scheduled commercial banks, including cooperative banks and the primary dealers, are only permitted to participate in the call or notice money market, both as borrowers and lenders. In call money market, funds are transacted, that is borrowed and lent, on overnight, that is only on 1 day basis. Under notice money market, funds are transacted for the period between 2 days and 14 days. These markets are of very short term duration and consequently highly liquid. Treasury bills. Treasury bills or the treasury bonds are the short term borrowings of the government. When government expenditure exceeds its revenue, then to finance excess expenditure, government issues the treasury bonds. However, RBI auctions these treasury bonds on behalf of government. Scheduled commercial banks, primary dealers, insurance companies and provident funds who maintain current account and security account with RBI are allowed to place their bid in auction. Other persons can also place their bid through commercial banks and primary dealers. There are two types of bids that are placed with RBI during these auctions. These are competitive bids and non-competitive bids. Competitive bid is for well-informed investors such as commercial banks, financial institutions, primary dealers, mutual funds. Non-competitive bid is available for individuals, cooperative banks, firms, companies, provident funds and trust. Under non-competitive bid, investors apply for certain number of bonds without bidding any price. These investors are then allocated securities at the average price of the auction. Certificate of deposit. Certificate of deposit is a negotiable money market instrument issued in dematerialized form or usance promissory note in lieu of deposits made with the person issuing certificate of deposit. Scheduled commercial banks and select all India financial institutions, that is Exim Bank, NABARD, NHB and SIDBI, can only issue certificate of deposit for deposits made with them. Maturity period of certificate of deposit should be minimum of 7 days and maximum for 1 year. The minimum size of deposit should be rupees 1 lakhs and in multiples of rupees 1 lakhs thereafter. There are restrictions regarding who can issue certificates of deposit. However, there are no restrictions regarding the person who could purchase these certificates of deposits. It can be issued to anybody, that is, anybody can purchase the certificate of deposits including non-resident Indian. Commercial paper. Commercial paper are unsecured money market instruments issued in the form of a promissory note that can be held in physical or demat form. Companies, primary dealers and financial institutions are allowed to borrow for the short term through the commercial papers. However, anybody including the NRIs and foreign institutional investors can invest their funds for the short term in commercial papers. Since commercial papers are mostly privately placed funds, so the issuer of commercial paper shall obtain credit rating for the issue of commercial paper from any Securities Exchange Board of India, that is SEBI. SEBI approved credit rating agencies. Now, maturity period of the commercial paper should be minimum of 7 days and maximum for 1 year. Commercial papers are issued at discount to the face value. Commercial paper must be issued in the denomination of rupees 5 lakhs face value and in the multiples of 5 lakhs thereafter. As it is issued in denominations of rupees 5 lakhs, so the minimum investment for the commercial paper is rupees 5 lakhs. Repos and reverse repos. Repos and reverse repos are the facilities allowed by the RBI to only schedule commercial banks and primary dealers to borrow funds in case of shortage of funds and lend funds in case of excess of funds on short term basis against the collateral of the government or the state government securities with the RBI. As these facilities are used to cover up any shortfall of fund or park excess funds on overnight basis, these facilities are known as the liquidity adjustment facilities. Repurchase agreements, repos. Repurchase agreements, repos are used for short-term borrowings. Repo contract is initiated by the borrower to sell the securities, that is the government or the state government securities, at a face value to the RBI with an obligation to buy the same security from RBI at some agreed future date at the face value along with the interest to be paid by the borrower. As this agreement contains both the features, that is first sale and then simultaneous repurchase, so it is known as repurchase agreement. Reverse repos. Reverse repo is just an opposite position of repos. Reverse repos are used to lend excess funds to RBI for short term duration. The lender initiates reverse repo contract and not the borrower, as in the case of repo contract. In reverse repo contract, lender agrees to purchase the securities from the RBI at the face value with a stipulation to sell these securities again to RBI at a face value and an interest thereon to be received by the lender. Conditions in respect of repos and reverse repos. RBI determines the rate of interest in case of both repos and reverse repos. Reverse repo represents the borrowing rate of the RBI, whereas repo represents the lending rate of RBI. As lending rate is higher than the borrowing rate, therefore repo rate is higher than the reverse repo rate. RBI has the power to conduct overnight or other longer duration repo or reverse repo at fixed rate or variable rates depending upon the conditions existing in the market. Currently, repo and reverse repo is conducted at a fixed rate for the overnight repos, reverse repos. Besides the overnight repos or reverse repos, RBI has also introduced 7 days and 14 days repos or reverse repos with effect from October 2013 at variable rate. Marginal Standing Facility, that is MSF. As these are several restrictions on borrowings by the commercial bank through repos, so RBI has introduced another facility for borrowing of funds by scheduled commercial banks only. RBI announced this facility in May 2011. Under this facility, commercial bank can borrow funds from RBI up to 1% of their net demand and time liabilities for overnight basis. The rate of interest in this facility is fixed and it would be higher by some percentage of the rate fixed by the RBI on repos for the overnight basis. Request from the bank under marginal standing facility should be received in minimum amount of rupees 1 crore and in multiples of rupees 1 crores thereafter. Repos on corporate debts, securities, commercial paper and certificate of deposits. Repos hitherto discussed are restricted to scheduled commercial banks and primary dealers only. However, RBI, with an objective to broaden the money market, has also allowed some other persons to enter into a different segment of repo market. However, this segment of repo market shall differ in the sense that collateral underlying repo in this market shall not be the government securities but the corporate debt security, commercial paper and certificate of deposits. Scheduled commercial bank primary dealers select all India financial institutions, that is Exim Bank, NABARD, NHB and SIDBI, non-banking financial institutions, mutual funds, insurance funds and housing finance companies are allowed to borrow from this segment of repo market. The tenure of borrowing in this segment of repo market shall be minimum of 1 day and maximum of 1 year. Corporate debt securities of more than 1 year maturity shall be eligible to be used in this market if they are held in demat form by the borrower who want to use these securities as collateral, are listed and rated AA or above by the rating agencies. However, corporate debt securities of less than 1 year maturity, commercial papers and certificate deposits are not required to be listed and held in demat form, but they are required to be rated AA or above by the rating agencies. All these instruments are valued at the market price for determining the values of securities to be used as collateral for borrowings. Collateralized borrowing and lending obligations, that is CBLO. Collateralized borrowing and lending obligation is a window for the short-term borrowing and lending. CBLO is complementary to the call or notice money market in the sense that it also gives opportunity to those participants who have been phased out from the call or money market. Call or notice money market is only restricted to the scheduled commercial banks and primary dealers. However, CBLO has wide array of participants which includes financial institutions, insurance companies, mutual funds, NBFC, corporate and provident pension funds besides scheduled commercial banks and primary dealers. CBLO market operates in completely collateralized environment and only government securities are used as the collateral securities in this market. Clearing the Corporation of India Limited has developed CBLO market. RBI regulates Clearing Corporation of India Limited under the Payment and Settlement System Act of 2007. Money market mutual funds. Money market mutual fund represents the investment in the money market instruments such as treasury bills, commercial papers, certificates of deposits, CBLO by mutual funds. Money market mutual funds are highly liquid with minimum lock-in period and offer returns that are higher than interest on saving deposits in banks. Other important thing is that anybody can invest in these mutual funds. These funds are professionally managed and regulated both by the Securities and Exchange Board of India and the RBI, thereby reducing the possibility of risk. Most importantly, these funds provide opportunity to small and retail individual investors to deploy their fund for short term in more profitable and secure manner. Other money market instruments. The instruments discussed hitherto are well known instruments of money market. However, there are some other instruments which are also frequently used in business. These instruments are as follows. First, bills receivable and bills payable. Second, promissory note. Third, debt securitization. As businesses operated and controlled by the individuals can only approach banks for the short term borrowings, so they frequently uses these instruments to cater their needs of funds for the short term. Let us now summarize what we have studied in this module. In this module, initially the concept of money market is explained. Money market is that part of financial market that deals in the short term instruments. Short term instruments are those instruments which are of maturities of 1 year or less than 1 year. Although term money market is somewhat misnomer as money market does not deal with money, but still its justification lies in the fact that in money market those instruments are traded whose maturities are 1 year or less, therefore making these instruments highly liquid and nearly equivalent to money. Like capital market, money market has also secondary market for the trade of existing money market instruments. Money market in India is mainly structured about two things, that is money market instruments and participants. Although money market nowadays has become so broad so as to include every participant, but not every participant is allowed to participate in every instrument. Participants in the money market are government, RBI, banks, non-bank financial institutions, companies and individuals. Government enters into the money market so as to fund their excess spending through the issue of government securities such as treasury bonds. RBI is a dominant and regulating player in the money market. It regulates many participants of money market and even carries the government borrowing program on the behalf of government. Effectiveness of monetary policies of RBI depends upon the effectiveness of the money market, so RBI makes full effort to make the money market effective. Commercial banks are the key players in the money market. The importance of banks in money market can be known from the fact that they are only players beside the primary dealers in the call or notice money market, and they influence almost every segment of money market. Non-banks financial institutions includes mutual funds, insurance funds, pension funds, etc. Finally, various money market instruments are discussed such as call or notice money, treasury bonds, certificates of deposits, commercial paper, repos, CBLO and money market mutual funds. Repos are the borrowing where government securities are used as collateral. Only scheduled commercial banks and the primary dealers are allowed to borrow through repos. In repo, RBI is a lender. On the contrary, reverse repo is just the opposite position of repo. In reverse repo, person lends to RBI. CBLO is a private window for borrowing and lending developed by CCIL in a completely collateralized environment. Only the government securities are used as collateral in this segment, and the scheduled commercial banks, primary dealers, financial institutions, insurance companies, mutual funds, NBFC, corporate and provident or pension funds are allowed to borrow and lend in this market. At last, money market mutual fund is discussed. Money market mutual fund is an investment by the mutual fund in the money market instruments.